bigger team. Let's now chart to 20, but it still wasn't, let's get to a billion. We did that, and everything was going great, and there was a real kind of opportunity for category leadership. And so we brought in Viking, a hedge fund, for $50 million of investment. Continued to go great, and then we just closed around with SoftBank for $150 million of investment at almost unicorn value. I think that's a great example of just kind of a rebuttal to the logical question that people ask about our model is like, are you limiting growth, or are you like metering, potential of companies? And I really would assert that we're not. We're just helping you get there in a more aligned way with more optionality, with better resilience as you go. And so we have now 3 companies that are approaching that status, and that's not our model. Like, we don't need those unicorn outcomes, but I think it just shows that if you kind of logically align with the team and your investors and your board, really good things can happen. So.
Yeah, that totally makes sense. So you mentioned kind of one of the risks with this growth at all cost model is that while your valuation may go up and you kind of keep chasing that next round of funding, it's an inflated value. There's not really an opportunity necessarily to exit, or there is an impending sort of drop off that's somewhere, just probably beyond reach. What are some of those other, I guess, challenges that emerge or risks that you see coming up when these companies try to achieve these incredibly audacious growth goals set for them?
It's a great question. So I'll talk about 2 of them. So just the valuation piece in and of itself, and this might sound weird, but I really like categories that oftentimes will have a like super well-funded, highly valued competitor that we're not talking to, and we're talking to the more reasonably sensibly capitalized vendor. That if you raise so much money at such a high price, at a certain point, like, there's not many companies on the planet that can acquire you, period, because they don't have the resource to do it. And so oftentimes you're planning to go public or whatever it might be. That's a whole different set of issues too, because then you're reliant on capital market, fluctuations and issues. And so if you raise so much at such a high price, you are really, and often entrepreneurs will tell me that they did that with with a lot of pride, which is natural. And with love in my heart, I say, like, that's awesome, but like, do you know what that means, right? Because if you raise $100 million at a billion pre, you have to be at peace with growing to 3 or 4 billion before you're even considering selling, because that entrepreneur friendly term sheet that you got from that investor, they're not very entrepreneur friendly if you go to sell the business for $1.5 billion and they don't make a great return, right? That's just not the case. And so that kind of proverbially backs you into a corner. And I see companies do it way too early, right? If you're 100 million of revenue and you do that probably makes sense. If you're 2 or 3 million of revenue and you've already backed yourself into this kind of single path corner, it can be kind of tricky. The other thing too that I would say is when you raise a ton of money early, in particular, regardless of the price, oftentimes you lose that DNA of like scrappiness and really just having to figure it out because you don't have the capital resource base to do so. You're based in Vancouver, Sarah. We love geos like that where there's not necessarily a plethora of growth capital. And so when we find companies, they've just had to grind it out, and that will stay with you forever. If you've raised like $100 million before your pre-product, it's really hard to claim that you're capital efficient or really know the value of the dollar. The really negative that comes with that is you're kind of always raising to get to the next raise.
Right.
And that's like a really tricky way to build a business because you're, again, reliant on the capital markets or the venture community to fund the business. So.
Yeah, absolutely. Okay, well, let's talk through taking the other approach, taking this more kind of slow and steady, building resilience, all that kind of stuff. What should leaders be focusing on instead? And you talked about this kind of milestone approach, your peaks. What are those milestones? Walk me through them.
Yeah, it's a great question. So for me and for us, just on day one or even before we partner, we just sit down and have a really pragmatic conversation with the team. And keep in mind, the companies that we're working with, typically the founding team, it's typically the first time they've done this, so they want the help. They typically own a lot of their company because they haven't raised gobs of venture capital. Those two things are really important, right? Because they're looking for a partner, and because they own so much of their business, they can sell for 150 or 200 million and have an awesome generational wealth event where if you own 3% of your company and you're a hired gun Silicon Valley CEO, you probably have to go for a big outcome too until you make a lot of money. And so that's a great kind of aligning dialogue that we have on day one, which is when we get to this first peak, and let's talk about what it is and the resource you need to get there. and the ostensible value of the company is X when we get there. We should be making our target return, which is 3 times our money. It's not 10. And you guys should be in a really good spot, personally, financially, and the business should be too. And so it removes a lot of the kind of just opaque stuff that I see with venture a lot, where it's like this black box and you don't know how folks got to their value or why they're interested or not. And so it's just a really candid conversation. Like, we share our returns model, we model out the returns for ourselves and every other member of the cap table, just to show if there's like incredible misalignment between the curves. It's just really hard to have a cohesive dynamic as a team and a board and shareholder base. And so we look to really eliminate that. And again, our whole just kind of model is about iterative, incremental, pragmatic, sensible expectation setting, and really just finding teams that get that and appreciate that. It's impossible for some people to get over. They can't get there, and they only focus on the pre-money. And that's fine. That's a big part of our job, is to really qualify those folks out early, because they're just not a great fit for our model. And so we really, we do qualify the type of entrepreneur, the type of business, that we work with a lot. We're really active with our teams. We look to kind of couple our expertise with a bench of operating advisors that can be really helpful to these teams. And, we're huge on just kind of collaborative dynamics around the table. And again, some companies don't want that, and they don't need that. They
Sure.
feel like they have it all figured out, and that's totally fine. They're just probably not a great fit for us.